Hello, students. How are you? I am fine, thank you. Let us start discussing accounting and finance course, which is designed for grade 11 students in the new Ethiopian education curriculum. Today we will begin with module 1. In totally there are 5 modules. Among these 5 modules, the first module, that is module 1, discusses about fundamentals of accounting. Under the fundamentals of accounting, you will discuss 4 units. The first unit discussing about understanding the concept of accounting. The second unit discusses about preparing and processing the financial documents. Unit 3 discusses about the accounting cycles. And Unit 4 discusses about preparing financial statements for sole proprietorship. Sole proprietorship differs from partnership, differs from corporation, and other types of ownership forms of the business. Therefore, under Unit 4, you will discuss about preparing financial statements for the sole proprietorship. Okay. Under the understanding concepts of accounting, there are another subtopics. The first subtopic, concept and the principle of accounting. The second subtopic, business transaction and accounting equation. The third subtopic discusses about communicating with the users of accounting information. Here, there are 3 subtopics under the first topic, that is understanding the concept of accounting. To understand the concept and the principle of accounting, first start with the meaning and the nature of accounting. The meaning means the definition of accounting. Let us define accounting. In short, accounting is the language of business. It is the language of business. That means accounting is just discussed and openly presented in business. It is the business language. The businessman or the businessman always need accounting. Therefore, we call it is the language of business, and this is a short definition of accounting. It also defined in long term. Let us define in the long term what is accounting. Accounting is the process of identifying, measuring, recording, analyzing, and communicating the required information which are related to the economic events of an organization or the business entity to the interested users of such information. Here, accounting information is interested by the users, interested by some users. Not all individual, all person, or all people need accounting information. Only those users of accounting information need the accounting information, or they want the accounting information. Therefore, it is the process of identifying, measuring, recording, analyzing, summarizing, and communicating the information, that is the financial information related to the economic events of an organization to the interested users of such information. This is a long definition of accounting. American Institute of Certified Public Accountant in the Gregorian calendar 1941 defined like this: accounting. It is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events, which are in part at least of financial character, and interpreting the results thereof. This is a definition given by the American Institute of Certified Public Accountant in the 1941 Gregorian calendar. Here, from the definition, we have to understand the basic activities of accounting, Here, the basic activities of accounting consists of three basic activities. One is identification. Here means identification of the economic events. Another basic activity of accounting is a recording of the economic events of an organization. And the third basic activity of accounting, communicating the economic events of an organization to the interested users. These are the basic three activities of accounting. Identification or identifies means the economic events must be identified by the accountant. Examples of economic events include the following. For example, the examples of economic events that must be identified by the accountant are, for example, sale of food and snacks by Haile Hotels and Resorts. A person or an employee who is working for Haile Resorts must identify such type of economic events, that is sale of food and snacks. Another, for example, an accountant who is working for Ethio Telecom must identify telephone services given by the Ethio Telecom. That is another economic event. And an accountant who is working for a particular organization, for example, purchase of machinery and equipment to the business is another economic event. Therefore, such type of economic events must be identified. Therefore, identification is the basic activity of accountant or accounting. The second one is recording. Such economic events must be recorded in the books of accounts of the organization. This recording takes place in a chronological order. That is step by step according to the time period which the economic events are happened. Such type of recording is known as a chronological, but it is not a alphabetical order or any other type of orders, but a chronological order, recorded in a chronological order to provide a history of its financial activities. The third basic activity, communicating, or communicates the collected information, that collected financial information, to the interest users. You will discuss who are the interest users next. Therefore, communicating the collected information to the interest users by means of accounting reports. Here, accounting report includes the income statement, which is called profit or loss statement. Another one is owner's equity statement, which is the capital statement, and the balance sheet statement also. Another name for the balance sheet statement is financial position statement and the cash flow statement. These are the main financial reports. Communication take place through these reports Okay, let us discuss the key components of account definitions that we have defined first time. Therefore, the definition of accounting includes the following components. That means who or whatever you define accounting, this component must be included in the definition of accounting. Otherwise, the accounting definition is incorrect. To make it is correct, you have to include the following components and the definition of accounting. These components are first economic events. Here economic event is one component of accounting definition. This economic event consists of transactions of the organization and which are measurable in monetary terms. Another component must be included in the definition of accounting is identification. It identifies or identification and the measurement, recording, communicating, analyzing, like that. Identification means determining or selecting transactions to be recorded in the organization, records of accounts. Identification means selection, because there are another type of events. Therefore, among those events, you have to identify, you have to select the economic event, only the economic event. Therefore, identification is one component of the definition of accounting. Another component is measurement or measuring. Here, measurement means quantification of a business transaction into financial terms by using monetary units. Another component is recording. Recording here means recording economic events or transactions in the books of account in monetary terms in a chronological order. Another component includes communication or communicating. Here communication means generating, preparing financial reports in a certain form to management and the other internal and external users of accounting information. Okay, another component that must be included in the definition of accounting is organization or business entity. This organization refers to a business enterprise, whether for profit or not for profit motive. Organizations are established for two purposes. One is for profit motive, another is for not for profit motive. Whether it is profit motive or not for profit motive, organization, because accounting information undertaken for the organizational object to achieve the organization objectives. Therefore, organization is another component of the accounting definition. Another component that must be included in the definition of accounting is interest users of information. Who are the interest users of accounting information? Those users need the financial information in order to make important economic decisions. The economic decisions, like these are like internal and external users of financial information of the business entity. Internal and external users of the business entity. Since an accountant undertakes the accounting profession or activity for the business organization, that business organization have internal and external users of the accounting information that he prepares. Therefore, those interest users are classified into internal and external users. Okay, let us discuss the nature of accounting. Nature of accounting means the characteristics or the features of accounting. What are the basic features of accounting? Accounting is a process. It is a process that is a feature of accounting. It is performing its activities step by step according to the objectives or the targets. Therefore, we call it is a process. Accounting is also an art. It is an art. Means it is a behavioral knowledge involving certain creativity and skill. Therefore, accounting is an art. Accounting is means and it is not an end. Means that accounting itself is not an objective, but it helps to attain a specific objective of an organization. It is a means but not an end. That is the feature. Accounting deals with financial information and business transactions. Just this is another feature of accounting. At every stage, accounting deals with financial information, starting from the transaction. Also, accounting is an information system by itself. It is a storehouse for financial information. Storehouse means just, storehouse. A house that is storing information just about the finance. Therefore, it is an accounting information system. Let us discuss the importance of accounting. The importance of accounting. Why accounting is important. First, accounting is the connecting link. It is the connecting link between the decision makers and the business operations. Therefore, accounting is very important to link between the decision makers and the business operations. That is the importance of accounting. For example, investors are the decision makers. For example, investors would have no way to distinguish, means to differentiate between a profitable company and on the verge of failure, on the way of failure. Since there is no accounting information, investors cannot differentiate between profitable company and the verge of failure company. Therefore, they get information from accounting reports. Another decision makers are bankers, for example. Bankers could not evaluate the riskiness of potential loans. Another decision makers are corporate managers, for example. Corporate manager means corporation managers. These corporate managers would have no basis. They have no basis for controlling costs and to set prices of products or investing the company's resources. They will get information through financial information or financial reports. Government, for example, would have no basis for taxing incomes. These are some examples why accounting is very important and how it link between decision makers and the business operation. Another importance of accounting is the availability of accounting empowers the business to run with efficiency, effectiveness, and accuracy or accurately. This is important. Another importance of accounting is the management will make the right decision, which is informed decision, and the proper planning due to what? Good flow of transactions, economic transactions, good flow of economic transactions in a business. And this also leads the management to what? To produce more. An organization to produce more. To more production. These are some importance of accounting. Let us discuss the users of accounting information. Who are the users of information? As I told you before, there are two broad categories of users of accounting information. The first is internal user, another one is external user. In general, the financial information that users need depends upon the kinds of decisions they make. It depends upon the decisions they make, because all decision makers don't want the same type of information. Therefore, it depends upon the kind of decisions they make. However, let us discuss the internal users and external users of accounting information. Internal users are managers who plan, who organize, coordinate, and run the business properly. Examples of internal users include the marketing managers. Marketing managers in the organization, there are different departments. Marketing department, for example, here market department has marketing manager. He is an internal user of the financial information. Another department, production department. In the production department, there are production managers and production supervisors. These also need financial information. Another department of business organization is finance department. Here, finance department also has financial or finance directors or managers, and these also need financial information. And company officers also. Company officers means employees. These also need financial information. And these are the examples of internal users of financial information. Let us ask some questions that the internal users ask. The internal users ask the following questions, and they get the answers also from what? From the accounting information. Here, finance director or finance manager asks, is company's cash sufficient to pay its operating bills, operating expenses? Therefore, this finance director gets the accurate information from the accounting reports. Another marketing manager, for example, asks the following question: what price should company set to a product to maximize their net income? Therefore, such question get answers from financial report. Human resource managers, for example, asks the following question: can Ethio Telecom afford to give its employees pay raises this year? Pay raises means salary increment. In order to increase salary for the employees of Ethio Telecom, the human resource managers must get financial information from the accounting reports. Management. The management means the different department heads of organization are known as management. This management, for example, Midrock Investment is business organization. In this Midrock Investment Group, management asks the following question: which Midrock Investment Group product line? Because there are different product lines. Among these, which product line is the most profitable? The most profitable. In order to decide the profitability of departments or groups, they, management, analyze and evaluate the accounting information of each department. Should any product lines be eliminated? Eliminate means destroy. Which should be destroyed? If it is not profitable, they decide that department to destroy from the another department. In order to destroy, destroying is just taking action or decision. In order to take that type of decisions, they must refer accounting information. Okay. Another users of accounting information is external users here. External users are the individuals and the organizations outside of company or outside of the organization who want the financial information about the company. Examples of external users are investors who are the owners of the company. Use accounting information to decide whether to buy a share or hold a share or sell a share. That means share is the ownership of company is known as share. Therefore, investors use accounting information to decide whether to buy, hold or sell ownership shares of a company. Creditors also are external users. These creditors, such as suppliers of an organization, and bankers, use what? Accounting information to evaluate the risks of granting credit or lending money. Customers of the organization are external users. They are interested in whether a company will continue to honor product warranties and support its product lines. Product warranties means some customers purchase or buy products from an organization with guarantees. In order to honor such product warranties, they get financial information from the organization. Labor unions. Here, labor unions are external users. They want to know whether companies have the ability to pay increased wages, increased salaries, and benefits to union members. Such type of questions analyzed and answered through referring the reports of finance or financial reports or accounting reports. Okay. What questions ask investors? For example, investors of bank, for example, ask, is Dashen Bank earning satisfactory income? How does Abai Bank is compared in size and profitability with Dashen Bank? Therefore, by comparing the accounting reports of Dashen Bank and Abai Bank, investors, those want to invest in Dashen Bank or Abai Bank, in order to decide which bank is profitable, they compare the financial reports of Dashen Bank and Abai Bank. Creditors, here creditors to airline, for example, those who are making loan to airlines are known as creditors. These creditors ask the following question: will Ethiopian Airlines be able to pay its debts as they come due? This question also get answer from the accounting information or accounting report of the airline. Tax authorities, for example, ERCA, Ethiopian Revenue and Custom Authorities, are known as tax authorities. Ask the following question: do the business companies in Ethiopia, for example, comply with tax laws? This is a question raised by tax authorities, and they will get also answers by referring the financial reports of companies which are prepared by accounting process. Regulatory agencies such as Accounting and Auditing Board of Ethiopia. This Accounting and Auditing Board of Ethiopia are a regulatory agency. Is the company operating within prescribed accounting rules and principles? These are some questions raised and they get answers from the accounting information by the external users. Therefore, there are internal and external users of accounting in broad category. Let us discuss accounting principles and concepts here. Accounting principle and concepts, they developed from the research, from the accepted accounting practices of different countries, and the pronouncements of regulatories. Another accounting and the principles are important because they make it possible to meet an essential objective of accounting. The objective of accounting is achieved through application of accounting principles and concepts. By the way, what is the objective of accounting? What is the objective of accounting here? The objective of accounting is the transmission of the reliable economic and financial information for those who read the accounting, accounts, and other financial documents. The reliable transmission of the reliable information to the readers of accounting. That is the objective of accounting. Therefore, accounting principles and the concepts are important to achieve the accounting objective. Accounting principles and the concepts, or what we call standards, ensure comparability of the financial statements across different entities In order to ensure high quality financial reporting, accountants present financial statements in conformity with accounting standards that are issued by standard setting bodies. Who are the standard setting bodies of accounting? International Accounting Standards Board and the Financial Accounting Standards Board are the accounting standard setting bodies. International financial reporting standards, which are applicable throughout the world, are issued and set by International Accounting Standards Board. United States Generally Accepted Accounting Principle also is set by Financial Accounting Standards Board. Hence, these two standard setting bodies have made the efforts to reduce the differences between International Financial Reporting Standards and United States Generally Accepted Accounting Principle. Through what? Through the convergence process. They are converged. These two standard setting bodies are converged. As a result of their convergence, there will be a single set of high quality of accounting standards that are used by companies around the world. Let us discuss the key assumptions, principles of International Accounting Standards Board. What are some key assumptions? Not all assumptions and principles, but some key assumptions and principles are presented in this module. The first one, business entity assumption. This business entity assumption states that the activities of the business organization must be kept separate and distinct from the activities of its owners and all other economic events. Second, the going concern assumption. This going concern assumption or principle states that the financial statements are prepared on the assumption that the reporting entity will continue in operation for the foreseeable future. Foreseeable means for everlasting future. Everlasting means indefinite period of time. Going concern assumption. When financial statements are prepared for the business organization, the reporting entity will continue in operation for the foreseeable future. This is the assumption. Don't think or don't assume that it will stop after 1 year or after 2 years or after 3 years. Don't think or don't assume that. You have to assume or think the business entity is operating for everlasting period of time, for indefinite period of time. This is the assumption of going concern. Another assumption is monetary unit assumption. This monetary unit assumption states that only those things that can be expressed in terms of money must be included in the accounting records. Must be included in the accounting records. Those economic events expressed in terms of money unit, monetary unit. Another assumption is time period assumption. Time period assumption states that the life of a business can be divided into artificial time periods, and that useful reports covering those periods can be prepared for the business. For example, for 1 month, or just for 1 day, or 1 week, or 1 month, or quarter, or semi-annual, or annual, that means a year. The life of business divided in these artificial periods of time. Therefore, reports also prepared in these different periods of times. This is the assumption of time period. Another accrual based of accounting assumption or accrual based of accounting principle. This states that the revenues of business organization are recognized when revenues are earned, and the expenses of the business organization are recognized when they are incurred. Unlike cash basis of accounting. Here, cash basis of accounting different from accrual basis of accounting. In cash basis of accounting, revenues are recognized or recorded when cash is received, and the expenses of business organization are recorded or recognized when cash is paid out. But here in accrual basis of accounting, the revenues are recognized when earned, and the expenses are recognized when incurred. Here, this accrual basis of accounting permits the transaction take place not only cash basis but on the credit basis is also possible. On the credit transaction on the credit basis is also possible according to this principle. Some key assumptions and principles also include another materiality assumptions. Materiality assumption. This materiality assumption states that the information means any information is material. When if omitting that information or misstating that information could influence the decisions of the decision makers based on the reported financial information. Otherwise, it is not material, it is immaterial. This is the materiality principle. Another is consistency principle. This principle states that the presentation, the classification, and the methods of items in the financial statements should be treated in the same way, in the consistent way, from year to year, unless a new or amended IFRS means International Financial Reporting Standard, requires a change in the accounts. Another is prudence or cohesion principle. This principle states that under the conditions of uncertainty, assets and income are not overstated, and the liabilities and expenses are not understated, and the vice versa is also true. This is the prudence or cohesion principle. Another one is the duality or the dual aspect principle. In this principle, for every transaction, there must be at least one debit and one credit account, so that for every transaction, debits equal credits, and then the accounting equation will be balanced. This is duality principle, just to make the accounting equation always to make it in balance. To make it balance, duality principle must be affected. In a transaction, in a one transaction, at least two accounts are affected. At least two accounts are affected. That means not only two, but more than two accounts may be affected. But at least two accounts affected, and among between these two accounts, one is debit, another is credit. Therefore, the amount given for debits must be equal to for credits, and this makes the account equation always balanced. This is a dual principle. Another principle is historical cost principle. Under the historical cost principle, this historical cost principle states that assets of business organization and the liabilities of business organization should be recorded at their historical cost, at their original cost. This is the historical cost principle. Another one, fair value principle. This fair value principle states that the assets and the liabilities of an organization should be reported. Reported means when preparing a financial report, under this financial report, assets and the liabilities should be reported at their fair value. Fair value means at their present value. That is the price received to sell an asset or settle a liability. The current value or the present value, that value is known as fair value. This done when historical cost is not present, is not unknown, is not known. That means if uncertainty is available in the preparation of financial reports for individual asset or individual liability, if you don't know the value, then the present value or the fair value must be considered. This is the assumption of fair value principle. Let us discuss the field of accounting. Field of accounting. Under field of accounting, you will discuss different fields of accounting, or what we call the job options of people in accounting field. Those who study accounting have different fields of account or professions, like auditing. Auditing have internal auditing as well as external auditing. Taxation or taxation is by studying tax accounting, you will become tax accountant. By studying the accounting, you will become auditor, internal auditor or external auditor. External auditors are known as certified public accountants. Those examines or reviews financial statements and issue their opinion based on the review of those financial statements are known as external auditors, and they are certified public accountants. But internal auditors are the auditor of the organization, auditors of the organization, what are the employee of the organization, are known as internal auditors. But external auditors are not the employee of the organization. They are just independent independent particulars, independent persons, independent professionals. Those examine the business financial reports, the business financial reports. Management consulting also. Management consulting is another field of accounting. Managerial accounting is another field of accounting. Forensic accounting, cost accounting, budgeting and fund accounting, financial accounting, accounting information system, international accounting are some examples of fields of accounting. Let us discuss the forms of business organizations. Forms of business organizations. Here, business types differ from business forms. Don't be confused. Business types and the business forms. Business types differ from the business forms. The business type includes the service business, for example, those provide services and generating their income through providing services are known as service business. Merchandising business means buy and sell merchandise to their customers are known as merchandise business. And the manufacturing businesses, those produce products are known as manufacturing business. These are types of business. But the business forms or the business ownership forms include sole proprietorship, partnership, corporation, licensing, franchising, joint stock company are some examples of business forms. But the basic or the common forms of business ownership are sole proprietorship, partnership, and corporation. These are known throughout the world. As the business entity concept, the accounting records of the business activities are kept separate from the personal records and the activities of the owners. Here, sole proprietorship, it is a business owned and managed by only one person. Only one person is the owner of the business in the sole proprietorship. The owner, or what we call the proprietor, receives any profits and he suffers any losses, if any, and is personally liable for all debts of the business organization only. That is, if the one person is the owner of the business, he is liable for the liability of the business. It is not a legal entity here. It is not a legal entity, but the accounting records of the business activities are kept separate from the personal records and the activities of the owner. This is due to what? The business entity concept, what we have discussed earlier. Partnership here. Partnership, it is like a sole proprietorship in most ways, except that it has more than one owner. The difference is just in partnership, not only one person is the owner, but more than one person become the owner of the business in the partnership. It is not a legal entity also, like as a sole proprietorship. It is not a legal entity, which is separate from the owners, but it is an association that brings together the talents and resources of two or more people. From an accounting standpoint, or from the accounting point of view, it is a business entity kept separate records from the personal activities of the partners. The owners of partnership are known as partners. Partners. They issue some articles which they agreed on the activities and how do they share the profit and the loss, what one particular take any activity, what can he do. Such agreements are set, and that is known as articles. They are governed by the articles what they issued. Each partner is personally responsible for the debts of the partnership. Under the partnership, under partnership, if there is a liability for the business, then each owner or each partner is personally responsible for the debts of the partnership. Just the third one is corporation or corporate form. This is another business ownership form. A business organized as a separate legal entity. This is a separate legal entity with ownership divided into transferable units of capital, which is called share. The owners of a corporation are called stockholders or shareholders. The corporation issues capital stock certificates to each stockholder, showing that the number of shares or stock he or she owns. In a corporation, since a corporation is a separate legal entity, the owners or the stockholders are not personally liable, just like as a partnership or sole proprietorship. Under corporation, each stockholder or the owners of the corporation are not personally liable. They are not personally liable for the debts of the corporation. That means limited liability. They have the limited liability. Liability is limited by the assets of the corporation. Here, their risk of loss is limited to the amount they paid or invested. Okay, this is the last subtopic for the first topic. We will discuss the second subtopic, that is the business transaction and accounting equation, for the next time.